Hello everybody. The objective of this video is to review the handful of pages that start in your section 2, module 1, or I should reverse that, module 2, section 1 on budgeting. So again, this is the second part post midterm, and it is module 2, section 1, budgeting. It's the first 2 to 3 pages. When you go there in your student's manual, you'll see a scenario where they're profiling a particular company. Our goal is to go through the handful of schedules and have a bit of a primer. Just, get a feel for the schedules involved in the overall budget cycle. Now, when we return to class, following this online session the week after, we're going to spend a lot more time on these individual schedules. So this is not for you to master the schedules, but just have an introduction to them, sort of a primer. The first schedule we're going to introduce is schedule of cash collections. Here, when you read the fictitious case, projected sales in April were $60,000. The company here believes that 60% of that will be collected in the month. That will give us $36,000. Well, the remaining 40% is collected in the following month. So we got this 60-40 split. Now, when time comes, we're not sure how we're going to collect those sales, but our anticipation before that period starts is we anticipate a 60-40 split here. You could have anything. You could have a 30-30-30-10 split. You can have 50% in one month, 40% in the following month, 10% the month thereafter. So it'll vary. This is the pattern we anticipate in this example. When we go through this, we come to the realization that we anticipate we're getting $56,000 worth of cash from sales activity. Even though sales earned were $60,000, we're only going to see $56,000 of it because of the pattern of our anticipated cash collection. So then, the first schedule of expected cash collection. Now let's take a look at the second schedule, inventory purchase budget. So we can recall from the first part of the semester where we're looking at an income statement and we had revenue less the cost of goods sold, or the cost of inventory sold, equals gross profit. Well, here we're revisiting that cost of goods sold again. In this example, there's a 75% cost ratio. So there's a belief that for every dollar generated in sales, 75% of that dollar will go towards the cost of inventory. So here, if we anticipate $60,000 worth of sales in April, we would anticipate also that $45,000 will go towards the cost of the inventory that we had to surrender to get that sale. So in April, if we believe $45,000 worth of inventory at cost goes out the door, we also have a management philosophy in this fictitious example that we want 80% of next month's cost of sales to be our ending inventory. So in other words, whatever we believe we'll sell next month at cost, and again, we're going to sell it for more than $54,000, but all it's telling us there, that's how much inventory we're going to have to surrender to get a greater amount of sales. Well, this company wants 80% of that sitting in ending inventory before this month starts. So whatever we think we'll surrender here as inventory at cost, this is what we want the prior month's ending balance to be. So think about it this way. We want 45 to go out the door, so we believe. We want 43.2 on the wall. We're going to need 88.2. If we start the year with only, if we start the month with only 36, then we're going to have to purchase 52. And you can work it backwards. I'm going to purchase 52.2. added to my 36, that gives me 88.2. Out of that 88.2, I believe 43.2 will stay as inventory at the end of the month, and 45 will be surrendered. Remember, 1 month's ending is the next month's beginning. So again here, 1 month's ending is the next month's beginning. The goal of this schedule is to determine how much our purchases will be of inventory. Remember, everything here is at cost. So we had a primer, an introduction to an inventory purchase budget. Now, in this particular example, this company has an anticipated opinion or pattern on how will they pay for that. And it's not going to be cash on delivery in this example. So they've come out with a policy. They'll pay half in the month they purchased and half in the following month. So if we see that 52.2, we say to ourselves, well, half of that is 26.1. Half will be paid in April, the other half in May. And if we see that our purchases are 64.8, we can make the conclusion when we build the schedule of expected cash disbursement for purchases, that 32.4 of that will be paid in May, and the other 32.4 will be paid in the following month. This 21.7, that was the accounts payable for March. That's half of March that wasn't paid in March, but is paid in April. So this schedule helps us calculate how much cash we're anticipating of dispersing in any 1 month in regards to our inventory. So if we pause and reflect, our first schedule that we've looked at, schedule of expected cash collection. How much cash do I believe I will collect in any 1 month because of my sales activity? Bear in mind, April, we're forecasted for $60,000 in sales, but we only anticipate achieving $56,000 in cash receipts. Also, as we do a recap, this purchase budget, we take our budgeted cost of goods sold, we add our desired ending inventory, that gives us our total needs, less our beginning gives us what we need to purchase. So another way of wording it, this cost of goods sold, what do you think will leave? The ending inventory, what do you amount will stay? The two is what you need, less what you're going to begin with is what you're going to need to purchase from your vendors. So this is taking a look as if I was buying finished goods and I'm reselling a finished good. If I was the manufacturer here, it'd be a little bit different, but we're focusing in on the reseller of a finished good right now. And then in the last part of our recap, the schedule of expected cash disbursement. How do I write the check for the purchases I've made? Excuse me. As we go forward, we have another schedule of expected cash disbursement. We have a handful of operating expenses introduced to us in the case: commission, rent, and other expenses. These expenses are paid as incurred. So if we're anticipating how much cash comes in, hence that's our first schedule, how much cash comes in. We're also anticipating how much cash goes out. This is cash out for inventory. This is cash out. This is also cash out because of operating expenses. What's one operating expense you do not notice here? Depreciation. Why? Depreciation is an operating expense, but it's not a cash disbursement. So that's going to be important. We'll show it in the income statement, but we won't show it in the cash disbursement. Now, again, we're just touching on the first handful of schedules to get comfortable. As the online portion, you can read those designated pages, read the fictitious example, read the scenario, go over some of the schedules. You can pause the video and certain answers when you're looking at the expected cash collection. You can pause the video and see the answers for purchase budget. And you can do the same for the schedule of cash disbursement, purchases, as well as operating expenses. Remember, you're not necessarily trying to solve this. This is a lot to handle here. It's just a preamble, a primer. In the next class, we'll be spending at least 90 minutes going over this example again. We're going to pause it though for now because I think we've chewed off a good amount. The last schedule, one of the more complicated and comprehensive ones, is the cash budget. How much cash do you anticipate coming in? How much cash do you anticipate going out? Let me just do the first column of April. Let's say from the case that we're going to start April with 8,000, as mentioned in the case. If we believe we're going to collect 56,000 in April, well, where did that 56 come from? We go right back to the beginning schedule, and there it is, 56,000. So I think you're going to start with 8 and then collect 56. So I believe, so I anticipate that gives me 64. 64 less these various cash disbursements, the first one being towards inventory at 47.8, and that 47.8 is our third schedule here, the 47.8 that we anticipate as cash disbursement for our inventory. We also anticipate 13.3 going out to operating expenses, which is here as well. In the case, in one of the paragraphs, they mention a $1,500 equipment purchase. That's a cash disbursement. So we think 64 will be coming in, 62.6 will go out. We have a small surplus of $1,350. But policy has that we must maintain a $4,000 balance. So we find ourselves that we anticipate we will be borrowing in the month of April. And remember, this month's closing cash is the following month's opening cash. This sequence and cycle does end with two financial statements, the income statement and the balance sheet, which we have taken a good look at in the first part of our semester. So, but this is good enough for bite size for now as a primer. So let you think about what we just said, and you can pause the video at any one time and reflect on the answers shown. And then in the following class, we're going to go much deeper. We'll leave it at there and wish everyone a good day. Thank you.